and welcome to the latest Astute quarterly market update. I'm Hannah Owen, Head of Group Communications, and I'm joined today by Dr. Scott Osborne, our Chief Investment Officer. So Scott, the first question I have for you today, can you talk us through what's happened in markets since we last sat here, sort of end of summer right through to autumn, please?
Yeah, sure. So actually the summer started off reasonably well. So end of July it was relatively positive, and then things changed. So then it started to feel a bit like a sort of mini 2022. So what happened in that period? So unfortunately, we're kind of back at central bankers again, which I know everyone's a bit tired of, but hopefully this is the last time we have them really talking the markets up or down. And generally what happened is we had this strong preference from all central bankers, so in the US, the UK, and in Europe as well, basically trying to convince markets that even if we were close to the peak in interest rates, which we probably are at now, they weren't looking to reduce interest rates or cut interest rates anytime soon. And to be fair, that's kind of always been our house view. We thought the markets were a little bit optimistic about expecting central banks to roll back on this monetary policy tightening in the early part of next year. But the markets had always kind of felt as soon as there was any risks around the economy or recession, then the Fed, the Bank of England, etc., would start cutting rates, and they were pretty firm through the early part of the summer or the middle part of the summer, saying no, rates higher for longer. We're at the job until it's done, I think is Bailey's line. There's still work to be done. All this type of narrative, and so markets then basically start saying, oh, okay, actually, we're going to have to forget about those cuts coming in the early part of 2024, and we're going to push those further back in time. And in fact, they kind of, in our view, went too far, and we've seen that a bit of that unwind in very recent markets, but they started basically pushing rate cuts all the way to the back end of 2024. We've always been more in the camp, these cuts or this easing will arrive in the middle part of next year. So what did that mean for markets? Like I say, it was kind of like a mini 2022. It was like interest rates going higher again, but it all happened at what we call the long end of the curve. So when you lend money to governments but for longer periods. And it was kind of distinctly different because most of the volatility we've seen in bond markets particularly has been just very sensitive to expectations of changes in rates per se. In the next 6 months are rates going to go higher or lower, whereas most of this move was all about, okay, well, if rates don't come down as quickly as what we think, they're going to be higher for longer. Just generally, and that led to this big repricing. Bonds really struggled. Equities, again, it was a bit like 2022. Equity markets struggled here generally, but it was a bit overdone. We think people basically panicked. Those who were expecting rate cuts to happen quickly panicked and kind of decided that they weren't going to happen at all, which is an overreaction. And we've seen some of that unwind more recently, and we've seen the US 10-year yield where it got up to kind of 5%, which has not been for probably a decade or so, and that was the peak pain point, and it's subsequently come back down a little bit more, kind of 4.6, 4.5, which doesn't sound like a lot, but that is actually a relatively big move for bond markets. So whilst this little sort of period was pretty tricky and pretty painful generally for most asset classes, a good portion of that's already unwound just in kind of the last 2 weeks, as we're speaking today in early November, as markets kind of come around to this idea that actually let's just focus on the fact that there probably aren't any more interest rate rises coming, and depending on the data, depending on how the economy does, depending on how inflation continues to fall, interest rate cuts will come next year. It's just a kind of debate about how soon or later they come, and that really you don't need to worry too much about that. All this kind of hand-wringing that occurred through the summer was probably a bit overdone. So yeah, that's it. It wasn't the funnest summer we've ever had in terms of markets, but like I say, a lot of that's kind of already unwound, and most markets are kind of back where they were in August, July times. Yeah.
Okay, brilliant. Thanks, Scott. Now, given that you've said that rates are due to be higher for longer, and that given the recent inflation figures that we've had for the UK, then now we know that interest rates are actually higher for inflation for the first time than they have been in a little while. Does this change our positioning at all?
Yeah, I mean, it's a good question in a sense, because we've literally just had in the last few days the most recent inflation reads from the US and the UK, And as kind of said, the implications for 2024 are now much more around, okay, well, is the economy okay? Are we going into a recession? And is inflation still coming down? And if the answer to both of those is yes, well, then you have that Goldilocks soft landing scenario, and everyone will probably be pretty happy about that. That's not necessarily the most likely outcome, but you still want to watch both of those factors very closely, growth and inflation. And on the inflation side, the numbers that we've had recently, it has come down. It's coming down probably slightly ahead of central bank expectations, in line with most market expectations. And that has been taken as a very big positive by the market. Like we say, if that's one of the drivers for risks around rates staying higher or even going higher next year, then it's starting to diminish. You can start to sort of write that risk out. And we've seen the market respond to that. We saw in the immediate aftermath of the sort of lower than expected US inflation figure, which I think was yesterday. Again, we're sitting down early November. We saw the US markets rip really high. In fact, the Russell, which is US mid-cap stocks, was up 5% in a day. And speaking to that aspect of, well, we're now at the point where interest rates are above expected inflation, i.e. you can get real returns on cash. Well, you're still going to get 5%, give or take, in the UK anyway. The Russell did 5% in a day, not a year. And that kind of speaks to our central thesis on our equity portfolio anyway, which is we're still more worried that we're going to miss one of these rallies than we are not. That we need to kind of be defensive and sit in cash, because that scenario, and don't get me wrong, the Russell 2000 index might give all those returns back in the next few days or whatever, but at some point we think that will happen, and you really do want to be in the market on those days. It's the old cliche about if you take the 10 best days of the markets in the last 20 years, your total return is significantly lower. Those are the days that you want to be in, and days like we saw when you get a 5% move are the days when you have to be in the market. So that's still our view, and even though cash is looking relatively more attractive as inflation comes down, risk assets are also looking even more attractive, and we're actually seeing the returns on those risk assets come through. As I say, a big move in a single day is not indicative of what will happen in the next 12 months, but it shows you just how powerful those moves can be. Without labouring the point, it's the characteristics of the bond market, with yields getting higher as they were, it just becomes more attractive as well. We've been positive on bonds for some time, and that's not changed either. As inflation comes down, we see that as a positive. If rates are going to come down, that's positive for our bond positions, but we don't really need that, to happen in order to make money. We can just collect the income from these. So yeah, it's for us, it doesn't actually change very much at all. That kind of inflation has moved, below interest rates. If anything, it is to us a trigger that, or further confirmation that you probably want to be net long risk at this time in the cycle, because that's historically where you would want to have been positioned, really.
Brilliant, thanks Scott. You really highlighted the importance of long-term investing there. You touched on bonds, and that's something that we've talked about previously. So I wonder if you could delve a bit into what characteristics about bonds specifically make them good for investing in now.
Yeah, okay, yeah. So I guess that's a fair question in terms of, we've been talking about bonds for a while now. In fact, we've probably been going from an underweight to overweight bond position. Started that maneuver this time last year. But if you look at where bond yields are, and when I say bond yields, that's kind of like, we say that what you get paid to lend to somebody. So like I said, the 10-year bond yield in the US got to 5%. What that means is that you get paid 5% a year to lend your money to the US government, and that's a high yield. The inverse of yield is price, right? So when I'm saying yields are high, you're also basically saying prices are low. And then if we look through history and answer that very narrow question of why are bonds attractive now, if you had bought bonds at today's prices throughout history, so again, when I say prices, if you bought bonds at yields where they're similar to today's yield, although actually yields have come in a little bit, you have always made better returns than the historical average. And it becomes a bit of a no-brainer. If you take treasuries first, for example, US Treasuries, I think the numbers we did, if you'd bought them at any time since the early 70s at a 4.8% yield, which is about where we were adding to our positions, your sort of 12-month ahead return almost doubles, and it gets into double digits. So it's got something like a 6% historical return to something more like a 10% historical return. And that's just in the next 12 months. So when the market says to us, here is now US government bond, zero risk of a default, albeit, you know, debt ceiling stuff is kind of a arbitrary risk. It's not real default risk. So there's no real credit risk on it. And we're going to pay you 4.8% no matter what. And then you say, well, actually, every time in history where this is kind of market has occurred, I've made 10% in the following 12 months. Yes, I'm very attracted to that asset class. And then folding into that again, this interest rate and inflation debate, another really strong reason why we're positive on bonds here is that if you look at bond market returns after every interest rate hiking cycle that we've had in recent history, and we can use UK data here, so you're thinking like every time interest rates have peaked in the past, so you know, through the noughties and early 90s, if you pick the point where interest rates peaked and then looked, okay, how did UK government bonds do after that peak, they always outperform cash, and generally we're actually making double digits again on UK government bonds. And not to labour the point, but these are essentially risk-free bonds. There's no credit risk involved in them. So if you can earn a 10% return on that, it's very attractive, and that's why we are drawn to bonds at this phase of the cycle. And then the final point on that is that regardless of the potential upside return on those bonds, the best case scenario for them in terms of total return, i.e. just how good could the return get on them, is that the economy crashes, right? Because if the economy crashes, then central banks are going to slash rates very quickly, and that's when bond prices will go up a lot. So it's not like we actually even think we're going to get that environment and we'll make the best level of returns from these, but the fact that they do give us that diversification benefit should a really bad recession occur is just like a really is like a cherry on top of the investment case for them, because it allows us to then continue to have that slight risk on bias in our equities, which you know we talked about a little bit earlier. So yeah, you combine the fact that versus history prices are very attractive, versus this economic rate hiking cycle, the timing is very attractive, and the fact that we get this brilliant level of diversification should a downside scenario materialize. For us, it's just a bit of a no-brainer at this point to be in the bond market. And it's exactly why, even as interest rates have gone up and cash looks more and more attractive, we have been reducing cash levels where we can and basically putting that into fixed income assets, because we're confident that we'll get better returns there, even over relatively short time horizons.
Brilliant. This is the last time that we'll meet on camera anyway, on screen, before 2024. Are there any tailwinds that you see on the horizon?
It's probably the stuff we said about interest rates and economic growth. If they come through, I think basically the markets are still pretty pessimistic. There's still a lot of end of the world-ism out there. You know, people think that that's what's going to happen. So at any positive upside surprise, there is the potential for a good rally. And like I said, we've seen that in markets relatively recently. When markets are pessimistic like this, it allows risk assets to, it's kind of this coiled spring. You're pushing down pressure on it, and actually if things aren't as bad as what you think, when those fears disappear, it springs back, and that's kind of the tailwind scenario. Tail risks, yeah, it's obviously hard to say this far out, but politics is clearly going to be a big one next year, so that's probably top of my list in terms of, we have elections in Taiwan in January, which could be a flashpoint between the US and China. We have the US elections themselves, and we have UK elections, both of which will be pretty hard fought. So it's never nice having political risk hovering around the markets, but that's probably one to watch out for next year as well.
Brilliant. Thank you for that, Scott. That's all we've got time for today. If you've got any questions about anything that you've heard here, which we hope you enjoyed, then please speak to your financial planner. See you next time.